Yes guys, good morning. So we'll start this chapter called as incomplete records. Now what is this incomplete records basically? Now you need to understand that not every businessman has that amazing accounting knowledge for you to prepare the entire dual aspect concept. You know double aspect concept, that is a different issue. But every businessman need not know a double aspect concept. So the accounting records, maybe he might not be even having sufficient funds to even employ an accountant as well. In such situations, what he'll maintain? He'll maintain only such basic set of records which he understands in his own format. He will not believe in what Luca Pacioli said, double aspect concept, debit, credit, all this he doesn't understand. He will just maintain it in the format in which we understand, as simple as that. So that is called as incomplete record. The other reason for incomplete record is, let's say on a particular day within a year, there were some riots which broke out. Now on the day of riots, let's say a few people have picked up your accounting records, also stole it away. Or let's say there was a fire accident which occurred in your premises. Your books of accounts also got burnt out along. So in such case, I cannot have a complete set of records with my hand. Now when I don't have that complete set of record, I'll have to prepare financial statements or your annual accounts using your incomplete records. Now what does an incomplete record indicate? An incomplete record indicates something which is prepared other than in a double aspect concept, as simple as that. Without following a double aspect concept, if I prepare my financial statements, we call it as incomplete record. Now in the sense, however, even if you are maintaining a complete set of record or you are maintaining an incomplete record, my function of accounting will always be at the end of every financial period. I'll have to ascertain their financial result, also their financial position. These two things are compulsory. When I say financial result, I am indicating towards identification of profit or loss. Position, I am talking about what are the assets and liabilities indicated through a balance sheet. Correct? So how do we prepare it from an incomplete record? If I have a complete set of record, I prepare a nice trial balance. After the trial balance, I go off to P&L, balance sheet, and I'll say that this is how your entire financial statements are prepared. But now I don't even have a trial balance also. Now I don't have a trial balance because I never followed a double aspect concept. I do not have a complete set of books of accounts. So I have only few information. From that few information, how do I get this? Now, normally incomplete record in the sense, either I am identifying or I maintain one thing every businessman compulsory maintains is cash book. This everyone will understand. Maybe not in the same format as you have to prepare a cash book, but at least he knows how to prepare what are the receipts, what are the payments, right? What is cash inflows and what are cash outflows. This every businessman will pakka maintain because this does not require any technical knowledge or accounting knowledge in preparing a cash book. Sales and purchases. Because these are already evidenced by some invoices. Sale invoice, purchase invoice. I clearly know how many goods I sold because I have bill numbers. Bill number 1 so much I sold. Bill number 2 so much I sold. Every month I am changing the bill book. Ultimately I have 12 bill books. A total of all the 12 books is equal to nothing but your total sales, right? So be it on cash basis or credit basis, I can definitely identify the total sales using the sales invoices. Same way purchase invoices. I purchase goods from so and so party. I'll file all those bills. All the bills together, if I calculate, that will become my total purchases. This he will never forget. Even if you wake him up from the middle of the night, he'll tell you this. How much each one has to pay and how much he owes to someone. How much he owes to someone he might forget. But how much he has to receive from someone he will definitely not forget. That's why receivables and payables are very, very important thing which every businessman will definitely indicate or will definitely write in a book. Opening due 1000 rupees, then again I sold 2000 rupees, then I received 2500, still outstanding 500. All this information definitely he'll write with respect to each customer, and that's what we call it as receivables and payables. Physical stock, he doesn't need to do anything. He will go inside, he'll check, he'll say that this is the openings, this is the amount of closing stock. Enough closing stock, opening stock will anyways get. Last year's closing stock, like that only he must have identified. That should become your current year's opening stock. Same situation, current year he goes down to the stockyard, he'll start calculating this many number of goods, this much number of goods, this many number of goods. He'll at least prepare a stock list which might not be in amount but will be in numbers. In the sense, X product I have 15 units, Y product I have 30 units. I'll at least give you the number of units, value we can attach at a later point of time. So physical stock closing is definitely there. So these are certain information which are available. Using this information, I did not give you expenses, right? I did not tell you what is the amount of assets which I have, but still this information is sufficient with other information which he provides from question to question basis to identify what is the total amount of profit or even the financial position of an enterprise on a given date. Clear? So this is what we talk about in an incomplete record. When you are identifying the result is nothing but profit or loss. He says that we can identify the result two ways. One is called as capital comparison method. One is called as complete record method. Your complete record method is nothing but through P&L account. He prepares a P&L account to identify the profit. But your capital comparison method, he will not create a P&L. Without even preparing a P&L also he can identify the profit. So let's try to understand what this capital comparison method is. Capital comparison method. Now, when we talk about capital, we know that as per dual aspect concept, assets is equal to liabilities plus capital. Now, this was our basic principle following your dual aspect concept. Every debit has an equal and opposite credit, and normally our journal accounting entries also will arise from your dual aspect concept only. So we'll always say that this statement always holds good. Now out of this, if I have to identify capital, if I'm only trying to identify capital, then I can put it like this, is equal to assets minus liabilities. My total assets minus total liabilities can be giving me what is the amount of capital. Now I can calculate opening. Also I can calculate closing. Opening capital, if I compare opening assets and liabilities at the beginning of the year minus assets and liabilities at the end of the year. Let me not write it as opening, I will call it as at the beginning of the year. Comparing my assets and liabilities at the beginning of the year, I get an opening capital. Assets minus liabilities at the end of the year will give me my closing capital. Now, once we identify the opening and the closing capital using your assets and liabilities, that is your position statement. Now, I have two sets of figures, that is opening capital and closing capital. Now, this opening capital and closing capital, we can identify the profit. If you remember the formula of closing capital, because we said always our closing capital is equal to opening capital, capital at the beginning of the year, plus net profit during the year, I'll call it as period, whatever period it might be, minus the amount of drawings during the period, plus some additional capital introduced. Now, this formula, if you observe, I know opening capital, I have got the closing capital, comparing my assets and liabilities at the beginning of the year and at the end of the year. I don't know net profit. This figure I am not really sure of, or this is what I have come to ascertain. If I can identify what is the amount of drawings and the additional capital introduced during the year, I can definitely calculate what is the net profit or loss. If I have to calculate net profit or loss during the period is equal to, come on, check now. I need to identify net profit or loss, so I'll talk about this way. Opening capital minus drawings plus additional capital as it is. I have taken this side. Now net profit to the other side and closing capital has been brought into this side. So you will have to reduce your amount of this way we can calculate. This comes out to be my net profit or loss. Here profit shows negative figure, guys, because I have taken it to the other side, so the plus becomes minus, so it shows a negative figure and nothing else. If you want to rewrite the formula, it will be closing minus opening plus drawings and minus additional capital. But since this is the format which we normally understand, we will take this format as a basic consideration. We can continue to solve. This is called as capital comparison method. So for me to start a capital comparison method to identify your net profit or loss, first I am going with using my assets is equal to liabilities plus capital formula. And we have compared assets and liabilities at the beginning, assets and liabilities towards the end to identify what is my opening capital and closing capital, compared those capitals, and then we got your net profit or loss during the period. So this way of calculation is called as capital comparison method. The next method that we will see is a more comprehensive method of computation where we actually prepare a P&L account complete set. Clear? Take it down. Yes guys, in comparison, when we prepare a complete record method, also called as comprehensive method, we prepare a P&L account to identify the net profit. So basically, to get the P&L, I also have to prepare a trading account anyways. From the trading account, get the gross profit, take the gross profit to P&L, prepare all your statement of expenses, statement of other incomes, and finally you get what is your net profit or loss during the period. But the problem when we do P&L account is, we need to have a lot of informations. While unlike in the capital comparison method, only assets and liabilities were sufficient, when you have to touch a P&L account, we need purchases, we need sales, we need the stock values or the opening and as well as the closing to identify the GP. Then to come to the net profit, we have other incomes like discount received from sale of some profit on sale of some asset. Now all that information also will become incomes. Other than that, some expenses like salaries, rent, miscellaneous expenses, all the expenses put together have to be identified, and that is where we prepare a P&L account and we identify your total profit or loss during the period. Comprehensive method is lengthy, but it is informative because exactly we get to know which expenditure has increased, which expenditure has decreased. If there is an increase in the net profit, I will get to know the reasons, and if there is a decrease in the net profit, I can identify the reasons and fix them up so that in the following accounting period we make sufficient profits at all, right? So whenever you talk about accounting, the basic purpose of accounting is informed judgments. So informed judgment in the sense, just by identifying the profit is not informed judgment. So that is only information that you are providing. To provide sufficient information to make a future judgments or future decisions, we need to have every detail of information. So if my salaries has increased, I need to know what is the reason for the increase in salary. Now, has there been a sufficient increase in sales as well? Since you increase the salary, that is the first thing that you have to understand. I have to compare it with someone else. What is the industrial standard of salary placement? Am I paying the same scale or am I on a higher scale? If I am on a higher scale, then what could be the reasons why I am paying a higher scale? Every assessment has to be done. So that is called as informed decision making process. Now for your informed decision making process, you need a comprehensive record, that is a complete set of P&L, rather than going by capital comparison method. Clear? So if we have to start a capital comparison method, we have a lot of accounts which we have to understand, we have to prepare, because it is an incomplete record, but you are preparing a comprehensive P&L. I am preparing a complete set of financial statements using my incomplete record. So I have to complete whatever is not complete. Yes guys, to see a complete set of records, we need to understand something called as sectional balancing. Now guys, we'll get this topic anyways at a later point of time when we're discussing about sectional balancing ledgers, but I need this concept here. Now when we do a sectional balancing, it basically means we find some account called as debtors. Now actually observe guys, there is nothing called as a debtors account. Debtor is a group of ledgers. Debtor is a group of customers. So whenever we see debtors, we do not write it as debtors account, it is debtors. That means debtor includes a group of customers. Could be A, could be B, could be C, could be Ram, could be Leela. Whatever it is, ultimately it is a list of all my customers, as simple as that. Now that list of customers, if I keep showing everyone as a customer in my balance sheet will run into pages and pages. Because even if I sell to 300 different people, 300 different line items, not possible for me to show it in the balance sheet. Or more or less we have seen something called as materiality. There is no point of showing that. We have to identify information in our financial statements in a more consolidated manner. So we are consolidating all the group ledgers of customers, grouping them as one head called as debtors. Now came a point of time where the senior accountant is doubtful whether the junior has actually recorded the entries properly in the customer ledgers or not. So what he'll do, he'll sit down with all those 300 or 400 customer ledgers, he'll start checking each one by one, he'll go on. Now that will take a lot of time. Instead, what they will do is to check the accuracy of only the debtor group. That's why I use the word sectional. So only that particular section of debtors, if I have to reconcile or if I have to find out what is the accuracy, then we prepare something called as total debtors account. This total debtors account will normally prove the accuracy of what is my debtors. That means instead of treating each customer as a separate customer, We'll group all the customers as one. I'm preparing one total debtors. I know what is the opening debtors value. That is the opening group of customers value. What is the sales? Irrespective. I've sold it to A, I've sold it to B, I've sold it to C, I've sold it to Z. I'm least bothered. I'll group all the sales and I'll record it as sales in my total debtors account. I received some payments. I received from A, B, C, D, whoever it is. I'll group all the payments, I'll put it there. I've allowed discount to a bunch of customers. Total the entire discount and put it there. Few customers became insolvent. We have recorded a bad debt. So what is the total loss on insolvency which is recorded as bad debt? Record it there. So entire thing I'll prepare a list of the entire ledgers, the entire accounts which are affecting my total of the debtors, and if I prepare a consolidated total debtors account, the balance, the closing balance of total debtors account should be equal to the sum total of each individual customer balances. Correct? My total balance, total debtors balance, whatever I have in the closing, that closing should be equal to the sum total of each customer ledger which is included under the group of debtors. Right? So that is the logic of preparing a total debtors account. Similar way, we have another sectional balancing which is for creditors. Creditors also we do not have an account. There is no account. It's a group. What group it is? It shows group of suppliers. And for this we prepare something called as total creditors account. I prepare a total creditors account to identify that the sum total of each individual supplier's account grouped under creditors will be exactly equal to the balance which is shown under total creditors account. Now, if I have to prepare a total debtors and total creditors, we'll just see what are the entries that will come. Try to pick the entries, guys, in both total debtors as well as total creditors. Fast. If you finished writing, you can check. Otherwise, continue to do it. You can confirm towards the end. Similar sense, if I am looking at a creditor, should open with a closing opening credit balance. Purchases during the year. Purchase returns during the year. Payment made in the form of bank or cash. Discount receipt from him. Also pay in the form of bills payable. Also can be in the form of bills receivable which are endorsed. Bills receivable endorsed is dishonored. Bill endorsed, dishonored. We cannot write bad debts here because we are still a going concern entity. Yes guys, try to pick your bills receivable and bills payable accounts as well. They will help you in preparing. When you have a bill, sometimes it really gets confusing. So you need even a bills receivable and bills payable account as well. Bills receivable always an opening debit balance. Bills received from debtors during the year. Such bill can be retained, or when there is retention of bill there is no entry. But the bill can be even discounted with bank, by discount, because the banker deducts some amount of discount charges on your bill or discount on bill, or the bill can be endorsed in favor of creditors by creditor. If you retain the bill, you receive cash on maturity date by bank or cash. Bill discounted to the bank, if it is honored on maturity date, the money will be received by banker himself. I will not record the entry. Bill endorsed to creditor, if the bill is honored on the maturity date, the creditor will receive. I will not record, but I will record each time there is a dishonor of the bill. So if I have a dishonor of the bill, then how do I even record it? Check now. First case. First, when the debtor has given the bill and such bill was retained till maturity, if honored by cash or bank, if dishonored, I will reverse the entry by debtors. By debtor, bill retained, dishonored. I am restoring my debtor. I am restoring the debtor by using that. But what about this now? Bill discounted with the bank. I already collected cash. Now if it is dishonored, the banker did not receive the payment. So who will have to pay the payment? We will have to make the payment. And then I will have to collect it from the debtor who gave me the bill. So I will record the entry as debtor account debit to cash. I will not affect my bills account at all. Similar way, even when we talk about endorsement to creditor, and if the bill get dishonored, I will not record the entry in bills at all. I will directly record between the debtor and the creditor. I will record the entry as debtor's account debit to creditor. It will not impact my bills receivable account by any chance. Clear? So this is the end of the entries, and towards the end you can have some closing balance. You will not have such detail in bills payable. Bills payable very small account. Begins with an opening credit balance. You normally accept bills in favor of creditors. Let the creditor hold it till maturity, let him discount with bank, let him endorse it to some other customer. We have nothing to do with it. We will either honor the bill or dishonor the bill. If something or the other we do. If I am honoring the bill, directly I will do to bank. If let's say I have dishonored, I will write it again to creditors, I am just reversing the entry. I will not do anything else. I cannot discount, I cannot endorse, I cannot do anything. I have this liability of payable to the bills payable. And guys, when you are preparing your single entry system, you do not have to go for schedule 3s or something. These are not for companies. What we prepare as for small entrepreneurs like partnerships or proprietorships. No company formats. You can prepare in whatever way you want, but make sure that you are identifying the net profit correctly. That is more than sufficient. And your balance sheet, be it any format, should tally. Right? So that is the first and the foremost point. So make sure that you are doing that. Right? So no schedules, nothing. So we'll go straight directly into the problems. So the first one which we'll talk about is capital comparison method. We'll start looking at the problems. Yes guys, check your question number 1. The first questions are quite basic, they are quite simple for us to understand and solve, but that is necessary for you to go into the next level problems. Be good with the basics first. Question number 1. 1st April 2011, Chodu started a business with an initial capital of 70,000 and on 1st October 2011, he introduced an additional capital of 40,000. On 7th of every month, he withdraws 5,000 rupees per household expenses. On 31st March 2012, his assets and liabilities were 2 lakhs and 70,000 respectively. Ascertain the profit earned by Chotu during the year ended 31st March 2012. Guys, he started with an initial capital of 70,000 as on 1st April. So I can consider this as opening capital. My opening capital is 70. On 1st October, he introduced additional capital. Additional capital 40. Drawings 5,000 on 7th of every month. 5,000 into 12. Total drawings during the year is 60,000. My closing capital I can easily identify using the formula of assets minus liabilities at the end of the year. Here it's given me assets and liabilities. On 31st March 2012, assets are 2 lakhs and liabilities are 70,000. So that is sufficient for us to get the closing capital, which is 1 lakh 30,000. Using this given information, I can calculate net profit or loss during the year is equal to closing capital minus opening capital minus additional capital Finally, plus drawings. Pick this information. 1,30,000 minus opening capital 70, additional capital 40, art drawings 60. So net profit or loss is 80. Net profit or loss during the period is 80,000. What would be your answer for the second one? Answer looks to be 6 lakhs. Net profit or loss during the year. Closing capital 25 lakhs minus opening capital 20 lakhs minus additional capital 1 lakh plus drawings 2 lakhs leaves me the final net profit of 6 lakhs. Looking at the third question, net profit or loss is 1,05,000. Closing capital is 1,50,000 minus opening capital 60,000 minus additional capital 25,000 plus drawings 40,000 will give me a total of 1,05,000 rupees of net profit. Fourth question is not about net profit or loss, but is talking about drawings. We need to identify the drawings here. Drawings during the year. Opening capital already given to us 3,50,000. Plus net profit during the year net profit for that year is given to us as 1 lakh plus additional capital $30 minus the amount of closing capital 4 lakhs. Drawings look to be at 80,000. Question number 4. The fifth one sounds kind of different type of question. Just check fifth one. A company sold 25% of goods on cash and the balance was sold on credit. So out of total sales, 25% is cash and 75% is credit. Debtors were allowed 2 months credit and their balance as on 31st March 2012 is 1,40,000. Assume that sales are uniform throughout the year. So guys, when I say that the credit period allowed is 2 months, what does it mean? Whatever I sold on 1st April, I'll receive the payment somewhere on 1st June. If I have sold it on 1st June, I'll get the payment on 1st of August. Sold it on 1st August, I'll get the payment on 1st October. Sold it on 1st October, I'll get the payment somewhere on 1st December. Move reverse way. If I am recollecting the payment on 31st of March, when did I make the sale? When did I make the last sale? What is the sale that is collected on 31st March? The amount of sale which we have done on 31st of Jan. Correct? 2 months. Exact 2 months of credit. All I can say is, so the sales which have incurred during this period, or what is this period I am talking about? 1st February up to 31st March, whatever is sale will be collected in subsequent year, correct? And this is what we call it as closing debtors. Absolutely. So this is my closing debtors. Now I think you got what I am saying. Check closing debtors. Debtors outstanding at the end of the year is 1,40,000. Which month sale is this? I am talking about the sale from 1st Jan up to 31st March. So that means I am talking about 2 months sale. So if my credit period is 2 months, so I can say average monthly credit sale is about 70,000, correct? Monthly credit sale is 70,000, then what is the total credit sales for 12 months? Total credit sale is 70,000 into 12. 8,40,000. What did he say? 25% goods are sold on cash, 75% goods are sold on credit. So I can say cash sale is to credit sale is equal to 25 is to 75. Or simply I can put this as 1:3. Therefore, the total cash sales, only I am talking about cash sales here, 8,40,000 into 1/4. 2,40,000. 2,60,000. 2 lakh 10. Therefore, my total sales means cash plus credit sale, both put together is 10 lakh 50,000. There is the total sales. Here, this is not 1 by 4, this should be 1 by 3. It should be 2 lakh 80. My total sale is 11 lakh 20. Next one, question number 6. Trader purchased goods for 1 lakh 70. If the opening stock of inventory prior to the said purchase is 30,000 and his sale is 2 lakh 10, find the closing stock of inventory if the gross profit margin on cost is 25%. Guys, sales are given to you, so I want a GP margin also on sales. I don't want GP margin on cost. So GP margin is given to us as 25% on cost, that is 1/4 on cost. I can say that if it is 1/4 on cost, it is 1/5 on sales. It is 1/5 on sales. So you know the total sales, you can find out the cost of goods sold. My sales are 2 lakh 10. GP margin, I'll write it directly on sales, 20% on sale. That is 42,000. COGS is equal to sales minus GP. 1,68,000. Cost of goods sold. Now you check. Opening inventory is there, purchase is there. You can calculate the closing inventory using the formula COGS of 1,68,000 is equal to opening stock given to us 30,000 plus purchases given to us 1,70,000 minus closing stock which is pending. I don't know what this value is. I am putting this as X. Therefore, my value of closing stock after substituting in that equation will be 32,000. So yes guys, let's move on to the next one. Problem number 7. In a concern, the opening provision for doubtful debts is 51,000. During the year, 10,000 has been written off as bad debts and the closing balance of sundry debtors is 6,30,000. It is decided that 10% of the debtors will be maintained as a provision. Calculate the amount of closing balance towards the provision and also pass journal entries to give an effect of the provision being maintained. Guys, remember guys, whenever we are talking about this provision, this word provision, they are neither real accounts, nor personal accounts, nor nominal accounts. They represent an account for which they are represented for. Let's say I am talking about provision for depreciation. If I use provision for depreciation, I am creating it on fixed assets. If I am creating it on fixed asset is a real account, so even a provision for depreciation will also become a real account. When I talk about provision for bad debts, I am creating provision for bad debts on debtors. and my group debtors are basically personal accounts. So even your provision takes the nature of personal account. So normally provision takes the nature of the account, it follows it by provision for depreciation, provision for bad debt, provision for an expense. So this way the provisions will take their nature. When we record for a provision is always created out of profits. That's why we call them as charge of profits. So we create an entry like this, P&L account debit to provision. Be it any provision, my entry will be recorded this way. P&L account debit to provision for bad debt, P&L account debit to provision for tax, P&L account debit to provision for bad debt, depreciation, whatever it is always created to P&L. So this is my entry which I create. Now here the question is talking about bad debts. So we'll have to create an entry as P&L account debit to provision for bad debts. So that means I'm expecting some bad debts in future. So I'm creating a provision to that extent. Let's say next year we already had a bad debt. We actually incurred a bad debt. So the entry should be bad debts account debit. Bad debt is a loss, debit all expenses and losses to debtor. Bad debt is a nominal account, should be charged to P&L. But I will not charge to P&L because I have already charged provision to the P&L. So I will cancel my bad debt using my provision for bad debt. So my entry will more or less look like this. Provision for bad debts account debit to bad debt. These are my set of entries which I have to record whenever I am creating a provision and whenever I am utilizing the provision for bad debt. Pick the entries. Yes guys, now check the problem. Now the problems make some sense. There's already an opening provision of 51,000. I'm not recording an entry because it's an opening provision. That means such amount of provision already exists. 10,000 has been written off as bad debt. So that should be my first accounting entry which I record. So the entry should be bad debts account debit to debtor, 10,000 rupees. Continue to read. The closing balance of the debtors is 6,30,000 and it is decided to maintain a 10% provision on them. So 10% on 6,30,000 is 63,000. What was the already existing provision? 51. Out of 51 I have written off 10. So first write off that amount. Provision for bad debt account debit to bad debts. So I am writing off the bad debts against your provision for debtor bad debts at 10,000. So my amount of opening provision has come down to 41,000 after writing off this amount. Now the amount of provision which is already existing at 41, I want to see it at 63. That is the amount of closing provision. So how much extra provision should I maintain? 22. So how do you record the entry? P&L account debit to provision for bad debts. Just to show some calculations, it is 10% of 6,30,000 amount of provision required, but out of this I already have 51,000 minus 10,000. 10,000 has already been written off of the opening provision, so I'm left out with 41. I need 63. Check your question number 8. From the following information provided to us for the month of March 2012, furnished by Harini and Company, prepare a total debtors account. So we have just seen sectional balancing total debtors. So the sales are given to us 68, but it includes a cash sale of 7. So credit sale is only 61. Debtors collected in cash are 57,000 after allowing a discount of 2,000 rupees to them. Bad debts written off are 1,500 and checks received are 10,000. So 57,000 received in cash, 10,000 received in check. But out of the check, 2,000 of check already got dishonored. There is a return inward, that is nothing but sales return, 700 rupees, and bad debts written off now recovered will not appear in your debtors account at all. Bad debts now recovered which have been written off earlier will be recorded as cash account debit to bad debts recovered, will not appear as a part of debtors account by any chance. So you can ignore that part of bad debts written off now recovered. Provision for bad debt. Provision for bad debt has nothing to do with debtors account at all. So we will not record even provision for bad debt in debtors. And the balance outstanding receivable at the beginning of the month is 20,000. So on 1st March it is 20,000, that is the opening balance. From this given information we can calculate what is the amount of closing balance. So let's start. Prepare a total debtors account in the books of Harini and Company. There will not be date column in total debtors, guys. We don't need date because we are preparing a consolidated account. Balance brought down, debtors always an opening balance. Opening balance of debtor is 20,000. Let's go on with the entries now. First one, sale 68,000 includes the cash sale of 7,000. Two sales. Only credit sales should be considered. That is 68 minus 7,000. 61,000 is credit sales. Collections from customers in from debtors in cash by cash 57,000. Next one is discount. By discount allowed 2,000. Bad debts written off 1,500. By bad debts. Check received 10,000 by bank. But the check which I got has been dishonored to the extent of 2,000, so reverse the entry to that extent. To bank, dishonor of check 2,000. Return inward is nothing but sale return. By sales returns 700. Bad debts written off now recovered has nothing to do with debtors. Provision for doubtful debts has nothing to do with debtors. Identify the closing balance. That is a balance as on 31st March. We have prepared total debtors for March. We started with the opening balance on 1st March. So we'll close out with balance as on 31st March. Yes guys, so let's get into those capital comparison problems which are one of the most frequently asked problems as far as single entry is concerned. Incomplete records is concerned, you find these problems repeatedly being asked. Let's start with problem number 9. Raju does not maintain his books of accounts under double entry system. but he keeps slips of papers for which he makes up his annual accounts with. He has borrowed money from bank to whom he renders figures of profits every year. He has given to the bank the following figures of profit. Starting from 2007 to 2011, these are the figures which have been furnished to the bank. Now 20,000, 32,000, 35,000 and 48,000 and 55,000. These are the 5 years profits given by Raju to bank. The bank appoints you to audit the statements and verify whether the figures of the profits reported are correct or not. For this purpose, the following figures are made available to you. His position as on 31st December 2006. Observe guys, the first year of profit which he has given to us is 2007. So my opening date will be either 1st Jan 2007 or we can also take it as 31st December 2006. So 31st December 2006 figures are given to us. Debtors at 20,000, stock at 95% on cost, you can take it at cost directly. So we have to add back that 5% to it. Cash and bank is 12,600, creditors are 6,000 and expenses are 1,600 which are due. That is nothing but outstanding expenses. He borrowed 5,000 from his wife on 30th September 2006 on which he has agreed to pay a simple interest at the rate of 12%. The loan was repaid along with interest on 31st March 2008. That means he hasn't been paying interest at all. He directly repaid the loan along with the interest on 31st December 8. Now what was the opening day? The opening day is 31st December 2006. As on 31st December 2006, this loan from White existed. Check. When did he take the loan? 30th September. But when am I doing the balance sheet? My first capital will be on 31st December 2006. So definitely we have to consider this loan given by wife along with 3 months interest outstanding. Because the loan was taken in September and we are drafting something on 31st December. So definitely 3 months of interest is also outstanding which should be considered. In December 2007, he advanced 8,000 to Raghav for the purchase of a vacant land. The property was registered in March 2009 after payment of a balance consideration of 32,000 and the cost of registration was 7,500. So the total cost of land is 8,000 advance, 32,000 balance payment, 40,000 plus 7,500 for registration. You get a legal deed which is drafted, total 47,500. Raju purchased jewellery for rupees 15,000 for his daughter in October 2009. Guys, jewellery purchased for his daughter, not for the business, should be considered as drawings. Next, marriage expenses concluded in Jan 2010 for 24,000. Again a drawing. A new DVD was purchased by him in March 2011 for 18,000, but however it was presented to him, to his friend in November 2011. Again a drawing. It is a gift to a friend for personal purpose. Again it is a drawing for 18,000. His annual household expenses amounted to a minimum of 24,000. Annual means per annum. Here I am doing 5 years. So 5 years, each year 24,000 has been withdrawn. The position of assets and liabilities as on 31st December 2011 was found to be as follows. Bank overdraft is 12, debtors are 10, expenses payable are 600, debtors including 600 due from a person declared insolvent by the court is 28,800. He is already declared insolvent, that amount is not receivable, so I will reduce the amount from my debtors. I'll make it as 28,200 after reducing 600 rupees as bad debts. Stock 125% of cost to reflect the market value. I'll have to get back to cost. I'll have to go back to cost. Cash in hand is 250. It was found that the rate of profit has been uniform throughout the period and the proportion of sales as a part of total sales was in the ratio of 3:4, 4:4, 6, 8. That is the proportion of sales, right? Ascertain annual profits, indicate differences if any with those reported by Raju to the bank earlier. All workings should form part of your answer. Go through the entire question once again and identify what is the total amount of drawings. Go through the entire question once again. There are different purposes of drawings. So try to identify what is the total drawing during the entire period of 5 years. Throughout 5 years, what is the total profit? Just total drawings, calculate. Yes guys, let me identify the drawings. Drawings during the period. The period which I am talking about here is a period of 5 years. Pick up one by one. The first point does not have it. The first point is only about assets and liabilities at the beginning. And then a borrowing from his wife has nothing to do with drawings. The third one, the point number C, is a purchase of an asset, has nothing to do with drawings. But starting from point number D, I have some drawings. So the first one, jewelry to daughter, 15,000. Second one, marriage expenses, 24,000. DVD gifted to friend, 18,000. Household expenses, annual household expenses, so 24,000 per annum for 5 years is 1,20,000. 1,77,000 is the amount of drawings. That is your total drawings. Now we need to identify opening capital and closing capital. I have drawings, no additional capital during the year. I can identify the profit as a whole for the entire 5 years. But for that I need to calculate opening and closing capital. How do you get opening and closing capital? Assets minus liabilities will give me capital. But for the presentation sake, we will prepare it in the form of a balance sheet. As a balance sheet will prepare, assets will write, liabilities will write, automatically the capital will become a balancing figure out of it. Right? That is nothing but assets minus outside liability. And this statement which I will be preparing here is called a statement of affairs. I cannot call it as a balance sheet, though I prepare it in the form of a balance sheet. I call it a statement of affairs because balance sheet by itself should balance, should not have balancing figures. Statement of affairs, to prove that there is a balancing figure, we prepare something called a statement of affairs. Here our capital value at the beginning as well as the end will become your balancing figures. So let's start. Same balance sheet format that we maintain, but maintain two amount columns, one at the beginning of the year, one for the end of the year. December 2016 beginning, 31st December 2006 is the beginning, 31st December 2011 is the end. Five years in between. Go on one by one. First I am reading the first statement, that is point number A, to fill up. Debtors are 20,000. Debtor is an asset. Debtors 20,000. Second one, stock in trade is also an asset. But bring it at cost. Check, it is given as 95% of cost is 47,500. Divided by 95%, you will get 100%, that is the cost. The cost is 50,000. Third one, Cash in bank 12,600. Creditor become a liability for us. Leave some balance at the beginning, that should be your capital. Creditors on the liability side, opening figure is 6,000. Last one, expenses due is also a liability. It is nothing but outstanding expenses, 1,600. That is a statement from point number A. Go towards point number B. He borrowed 5,000 from his wife's loan. $5,000. Do not forget to write interest outstanding. Why would I write interest outstanding? Because very clear he was, they have agreed to pay a simple interest at the rate of 12% per annum. The loan was repaid along with interest on 31st March 2008. I am preparing on 31st December 2006, so interest is not yet paid. Loan taken in the month of September 2006. I am preparing a statement of affairs on December 2006. So 3 months interest is outstanding. 5,000 into 12% into 3 by 12. 150. Continue. In December 2007, that means it was not existing on 31st December 2006. December 2007, he gave 8,000 as advance for purchase of a vacant land. March 2009, he paid the balance 32,000, purchased the land, registered it by paying again extra 7,500. So that vacant land will not appear as an asset on 31st December 2006, but it will be existing on 31st December 2011 for 47,500. You might ask me about depreciation, but my reply would be it is land. Land is not a depreciable asset, so straightforward at cost I am taking. 8,000 advance, 32,000 balance, plus 7,500 for registration, total 47,500. Point number D, E, F, we have already considered in identifying the total amount of drawings. Come down to G to get the final position as on 31st December 2011. Bank overdraft is 12,000. That is a value existing on 31st December 2011. Next one, creditors are 10. We have already written opening creditors, write corresponding figure in the closing column. Expenses payable 600. Expenses due we have already written. Corresponding item in the closing column 600. Debtors, it includes 600 rupees due from a person declared insolvent by court. That person is already insolvent, so reduce that 600 from 28,800 and you will get 28,200 as closing debtors. Continue. Stock at 125% of cost to reflect the market value is 60. 60 is 125. So how much is 100? Divided by 125%, 48,000. Check. 60,000 divided by 125%. Cash in hand is 250. Check the items for which I did not get a corresponding figure in the closing. Wife's loan. When was it repaid? On 31st March 2008. I am preparing on 31st December 2009. By that time, wife loan is not there. Correct? So that is it. That is all for the statement of affairs. Identify your opening capitals and closing capitals. $69,850 and closing capital is 1,01,350. from your statement of affairs, we have to calculate the net profit for 5 years. So first calculate net profit for 5 years. Yes guys, now check net profit. Net profit for 5 years starting from 7 to 2011. How do we get? Closing capital 101,350 minus opening capital $69,850 plus drawings. No additional capital for us. And that's it. That will give me my net profit for 5 years. $2,08,500 is a combined profit for all the 5 years. But we'll have to make sure that we are identifying what is the net profit each year. But for that, we need to check the last information given to us. It was found that the rate of profit has been uniform throughout the period, and the proportion of sales during the year to the total sales for the period was in the ratio of 4:4:6:8. So this is the ratio of sales. So sales ratio is 3:4:4:6. Check rate of profit is uniform. Sales into net profit percentage will also be equal in the same ratio. Because it is uniform percentages get cancelled. So sales into net profit will also represent the same formula. Sales into net profit is nothing but the net profit each year. So if your sales are in the same ratio and if your net profit percentage is uniform, then even your net profit will follow the same ratio, that is 3:4:4:6:8. Now what is he asking us to find out? He's asking us to check, it is found that the rate of profit is uniform, proportion of sales to total sales during the period is in the ratio of 3:4:4:6:8. Ascertain what is the annual profit, indicate differences if any, which have been reported by Raju to banker earlier. So we have to find out the differences. Difference in profits reported. He has reported some profits to banker. We will see if there is some difference. First column with year, second column with actual profit, third column is reported profit, which is already given figure for us, and finally identify what is the difference in the profits reported. We'll have to talk about the year 7, 2008, 2009, 2010 and finally 2011. These are the 5 years I'm talking about. Actual profit, we have already calculated this amount as 2,08,500, and we know that it is in the ratio of 3:4:4 6:8. Calculate in that ratio, compare with the profits reported to the bank. Profits reported to the bank are 20, 32, 35, 48 and finally 55. These are the profits reported. Total profits reported are 190. Total difference is 18,500. Your profits and your difference of profits are 5020 first year, second year 1360, third year will be a negative figure of 1640. Next one 2040, last year huge difference of 11,720, giving us a total difference of 18,500 which has been short reported to the bank. Those are the difference in profits reported. If we're done with this, then we can move on to the next problem. Go for the next question, question number 10. A and B started business as on 1st Jan 1993 with 50,000 as a capital contributed equally, but the profit sharing ratio was 3:2 between A and B. The drawings are 300 rupees and 200 rupees per month respectively. They kept no accounts except for the following information which is made available. So as on 31st December 93 and 31st December 94, 2 immediate years he has given us the opening as well as closing data for assets and liabilities. Provision is to be made for depreciation at the rate of 10% on the cost of machinery at the end of each year. Debtors as on 31st December 93 include 5,000 for goods sent out on consignment at 25% above cost, and the goods are not sold until 1994. Next, a check of 1,000 rupees which was deposited on 31st December 93 was only credited on 2nd Jan 94. A check for 2,000 rupees issued on 26 December 94 was presented for payment on 3rd Jan 95. A check for 1,000 rupees was directly deposited by the customer on 27 December 94, and a check for 500 deposited in December 94 was dishonored. No adjustment for these were made and determined the profits of 93-94 and dropped the balance sheet as on 31st December 1994. Now, 2 years, only 1 year information, 2 year data, one at the beginning, one at the end is given to us. 93 end is nothing but 94 beginning, also 94 end is given to us. But if you have observed, come down below towards the end, we observe that the figure given to us as far as bank balance is concerned in the statement of assets and liabilities is balance as per passbook. When I prepare financial statements, I am least bothered about balance as per passbook. I need balance as per my cash book. So to get the balance as cash book, we need to make some reconciliation. Some changes are there. So we'll have to make some reconciliations. We have to make some certain changes to identify what is the bank balance as per the bank book as on 31st December 94 and 31st December 93. So let's start. Put a heading, bank balance as per cash book. Some adjustments given there, you can make a note of those adjustments and start calculating. Bank balance as per cash book. December 93 and 31st December 94. Start with balance as per passbook. Passbook balance is 6,000. 8,000. Continue. The first one is regarding provision for depreciation, that anyways I'll provide it at a later point of time, and debtors include 5,000 for goods sent on consignment. We'll have to make an adjustment to debtors as well. And finally from there starts your adjustments. After the second sentence, that is after your debtors, starts your adjustments. A check for 1,000 rupees has been deposited on 31st December 93 but was only credited on 2nd January 2004. Checks deposited but not collected. Passbook balance will be low, but my cash book balance will be high because I have deposited the check automatically as on the date of deposit itself. I'll pass the entry in my cash book. So increase it. Which year should I increase it? A check for 1,000 was deposited on 31st December 93. So I'll add 1,000 rupees to 31st December 93. Next, a check for 2,000 which was issued on 26th December 94 was presented on 3rd Jan. Checks issued but not presented. I issued the check, not presented. So passbook balance is still high, but bank balance should reduce as per my cash book, because as and when I issue the check, I'll write the entry in my passbook. So as if the payment has already been made out. So we'll have to reduce this balance, 2,000 rupees in the year 94. Next, a check of 1,000 was directly deposited by the customer on 27 December 94. Direct deposit by customer. If the amount was directly deposited by the customer while preparing cash book, I don't know. But my passbook balance is high because the amount already came into the account. So I'll have to reduce it. Which year? He has done that. A check, a 1,000 rupee check was deposited on 31st December 94. So minus 1,000. I will not pass the entry in the cash book yet. I did not know the information about it. 500 rupees check deposited in December 94 was dishonored. Check dishonored. I did not know that information. So my passbook balance will be lower because passbook did not get the balance. But cash book balance, I have deposited the check. automatically my cash book balance is higher. So add that 500 rupees. Balance as per cash book 7,000 and 5500. This bank balance as per cash book. Start preparing. I need as usual a statement of affairs. Let's start, guys. I'll go in the order in which I see the amounts given to us in the question. First one I see machinery, then I'll come down below and I'll check. Provision is to be made for depreciation is to be made. That means it was not made earlier. I am making it at the rate of 10% on the cost of machinery at the end of each year. One more evidence which I have there is in the information given to us, it is given as machinery at cost minus 10%. Minus 10% will be 18,000 and 22,500. Cost minus 10%. 10% was the amount of depreciation being provided. Debtors as on 31st December 93 include 5,000 rupees for goods sent on consignment at 25% above cost. So be careful about that. There is no change in stock. Let me consider stock as it is at 30,000 only. But extra over and above the stock, I have something else called as consignment stock which comes up. What is consignment stock? The stock with consignee should also be treated as consignment stock, my own stock. But what is the value? 5,000 was included in debtors. I'll reduce it from debtors. I'll include it as consignment stock. But at what value? That 5,000 rupees is the selling price. It is 25% above cost. So if it is 1/4 of the amount above cost, 1/5 above selling price, so 5,000 minus 20%. That is 4,000 rupees, and I will write it under 31st December 93 column. This was sold off in the next year, so will not appear in the closing column. Now touch debtors. I will reduce 5,000 rupee of debtors from the opening balance since it was sent to the consignee. No similar adjustment in closing. Take it at 60,000 value given to us. Now comes the final two items for us to pick up. One is cash, other one is bank. Cash you can fill up as it is, the figures given to us 2,500. Bank I will fill up balance as per cash book which we have just calculated. 7,000 and 5,500. I will have to identify capitals, which I will do at a later point of time, because these figures will become balancing figures for me. The other liabilities which are given to us are creditors, 30,000 and 20,000. Outstanding expenses, $4,000 and $3,000. I'll have to stop with the outside liabilities there. There's no extra liability which is arising again. So that's it. Identify. Guys, I'll just mark these two as important. 5,000 reduced from debtors, but consignment stock only recorded at 4,000. Very important adjustment. Bank anyways we have showed a separate working note. You can easily relate to that. Identify what is the opening capital and the closing capital. So guys, these are the capital balances at the end of 93 and one at the end of 94. Now read the last statement. Determine the profits in 93 and 94. That means 2 years profits we want, and drop the capital balance sheet as on 31st December 94. Guys, for 94 this is opening capital fine, this is closing capital fine. For 93 this is closing capital fine. Opening capital is given in the first statement. A and B started a business on 1st Jan 93 with 50,000 being capital contributed equally. So that is opening capital for 93, right? So you have opening capital for 93, closing capital for 93. Opening capital for 94, closing capital of 94. You can identify the net profit if I have drawings. Drawings, straightforward figures are given. 300 and 200 per month by each part. So that is sufficient for us to calculate. So let's start. Computation of net profit, '93 and '94, 2 years. Start with your closing capitals. 72,000 is a closing capital of 93. 95,500 is a closing capital of 94. Less opening capital. 93 itself they started the business with 50,000. For 94 years, you can take last year's closing capital as opening capital. Finally, add drawings. We have two partners, A and B. A withdraws 300 rupees per month, so 3,600. 300 into 12. B is 200 into 12. This is 3,600 and 2,400. Each year drawings of both the partners is 6,000 rupees each. First year net profit is 28. Second year net profit is 27,000, 29,500. 28,000 and 29,500 are your net profits for 2 years. Now check your profit sharing ratio. These profits are shared between A and B in the ratio of 3:2. Share it between A and B in 3:2. Share of net profit A and B in the ratio of 3:2. Distribute 3/5, 2/5. Distribute it in the ratio of 3/5 and 2/5 and you will get the answer. Divided by 5. 546, 5,600. These are your share of profits of both A as well as B. I've done that to identify what are the capital balances. Because for me to draft the balance sheet, because check last sentence, determine the profits and also drop the balance sheet as on 31st December 94. For me to drop the balance sheet, I need what is the capital balance of each partner, that is A and B. So let's try to identify the capital balance of each partner. Check at the beginning of 93, the capital contributed with 50,000 equally, so 25,000 each. Then add their share in net profits. 93 they earn net profit, 94 they earn net profit. 93 net profit is 16,800 and 11,200. This 94 net profit is 17,700 and 11,800. From this, reduce their drawings less. They must have withdrawn for both the years, 93 as well as 94. Each year they withdraw 3,600 for A, 2,400 for B. And you get their capital balances. Capital balance as on 31st December 94. $52,300 for A, $43,200 for B. This is A and B's capital. Once you have A and B's capital balances, you can present the balance sheet straightforward. Balance sheet as on 31st December 94. Capital balances AB 52,300, 43,200. Total 95,500. Other assets and liabilities you can copy paste from the statement of affairs that we have prepared. Creditors 20,000. Expenses outstanding 3,000. For the assets, copy paste you have 31st December 1994 column, machinery 22,500, stock 30,000, consignment stock, that is nothing but the stock with the consignee. I valued it at cost 4,000. Corrected debtors after reducing 5,000 rupees for amount sent to consignee 45. No change with cash 2,000 as it is. Bank balance as per cash book which you have considered is 7,000. That's it, and there your balance sheet should tally. And that's the reason why we call it as a balance sheet, because it always balances. Yes guys, by mistake I picked up the 93 column, take 94 column. So your debtors will be 60,000. Cash is 500, bank is 5,500. Yeah, the remaining figures are correct. 94 column only I picked up.